You wake up before the city is fully alive. Your phone lights up. A few taps later, coffee is ordered, payment confirmed, receipt archived. The transaction feels simple, almost invisible. But beneath that quiet moment sits one of the most radical economic systems humanity has ever built. Nothing physical moved. No object changed hands. No vault opened. What occurred was a synchronized update between machines' numbers, shifting across ledgers, maintained by institutions you will never see. The value you exchanged exists mostly as agreement, not substance. It lives inside databases, protected by passwords, regulations, and collective belief. Now imagine stepping into the same moment 2 centuries ago. You enter a coffee house lit by candles. You place a small metal disc on the counter. It has weight, temperature, sound. The merchant examines it, not because he doubts you, but because the coin itself carries value, independent of any ruler or institution. Once it leaves your hand, the transaction is complete. There is no intermediary, no promise, no delayed settlement. Ownership transfers instantly. These 2 moments reveal more than technological progress. They expose a complete transformation in how civilization defines value, trust, and power. For most of history, economies were anchored to things that existed whether governments did or not. Land, crops, metals, labor, wealth, could be touched, measured, and stored in forms that resisted manipulation. The pace of growth was slow, but the rules were visible. Modern economies operate differently. Value today is abstract. It flows through systems designed for speed, scale, and expansion. Money is no longer a thing, it is a process. Understanding this shift explains far more than inflation charts or housing prices. It explains why entire generations feel as though they are running faster but moving nowhere. It explains why stability feels temporary, and why economic decisions made thousands of miles away can reshape daily life overnight. For thousands of years, money emerged naturally from trade. Societies gravitated toward materials that were scarce, durable, divisible, and widely desired. Gold and silver weren't chosen by decree. They were chosen because they worked. They could not be forged easily. They did not decay. They could store value across seasons, wars, and dynasties. This imposed limits. Growth required effort. Expansion required production. If more money was needed, more metal had to be found, mined, refined, and minted. This created friction, but also discipline. Empires rose and fell within this framework. Some diluted their currencies by reducing metal content. Others taxed heavily or expanded territorially. But none escaped the underlying constraint. Value could not be summoned instantly. Prices fluctuated, sometimes violently, but over long spans they remained anchored. A unit of money represented a stable claim on real resources. Saving was rewarded. Time favored patience. This balance began to change not because metals failed, but because governments encountered problems metals could not solve quickly. War accelerated everything. Large-scale conflict demanded immediate resources: soldiers, weapons, logistics far beyond what treasuries could supply. Suspending convertibility became a temporary solution. Temporary solutions, once proven useful, rarely remain temporary. As paper claims replaced metal redemption, trust replaced substance. What began as an emergency measure became a permanent feature. By the mid-20th century, the world operated under a hybrid system: paper currencies, referencing gold indirectly, mediated through international agreements. It was stable only as long as discipline held. When discipline failed, the last anchor was removed. At that moment, money ceased to be a claim on something tangible. It became a claim on future productivity, enforced by law and sustained by belief. This wasn't inherently malicious. It allowed unprecedented flexibility. Governments could respond to crises faster. Credit could expand. Economies could grow without waiting for mines or harvests. But it changed the rules completely. Money was no longer limited by nature. It was limited only by confidence. And confidence, once shaken, behaves differently than metal. Modern money is not primarily issued by governments. It is created inside balance sheets. When a loan is approved, new purchasing power appears. It did not exist moments before. It is not transferred from someone else's savings. It is generated as a contractual obligation, tied to repayment over time. This mechanism fuels expansion, but it also introduces a requirement that did not exist before: perpetual motion. Because repayment destroys money, new lending must always exceed old repayment to keep the system stable. Growth is no longer optional. It is structural. This is why slowdowns feel dangerous, why recessions are treated as emergencies, why intervention has become routine. In older systems, Downturns were painful but finite. Prices adjusted. Weak enterprises failed. Recovery followed. In the modern system, contraction threatens the foundation itself. Debt without expansion becomes unpayable. Defaults cascade. Liquidity disappears. To prevent this, central authorities step in not as producers, but as stabilizers. They lower rates. They inject reserves. They purchase assets. They smooth volatility. This works, but not without cost. When new money enters the system, it does not distribute evenly. It flows through financial institutions first, then asset markets, and only later into wages and consumption. By the time it reaches everyday transactions, prices have already adjusted. This dynamic reshapes society quietly. Asset holders benefit. Wage earners lag. Savings erode. Risk is rewarded. The economy becomes less about making things, and more about positioning within financial flows. At the same time, production itself stretches across borders. Efficiency increases. Costs fall. But dependence grows. A single device might rely on dozens of jurisdictions, hundreds of firms, and logistical precision measured in hours. When it works, abundance feels effortless. When it breaks, scarcity appears suddenly. Local resilience gives way to global optimization. This transformation brings extraordinary material comfort, but also fragility. Shocks travel faster. Recovery takes coordination. Redundancy is viewed as inefficiency. Meanwhile, consumption becomes the engine. Not because people need more, but because the system requires motion. Spending sustains output. Credit sustains spending. Confidence sustains credit. Saving, once foundational, becomes paradoxical. Individually prudent, collectively destabilizing. Culturally, values shift. Debt loses stigma. Leverage becomes normal. Growth becomes expectation. None of this is accidental. It is the logical outcome of removing natural constraints. And it leaves individuals navigating an environment fundamentally different from the one their predecessors understood. In this environment, traditional advice often misfires. Strategies designed for a stable monetary base struggle inside an elastic one. Currency is no longer a reliable store of value over long horizons. It is a temporary medium, designed to move. Holding it indefinitely guarantees dilution. Ownership behaves differently. Assets tied to real production, scarce resources, or essential services tend to adjust with monetary expansion. Abstract claims without yield do not. Debt, once feared, becomes asymmetric. When fixed and paired with appreciating assets, it transfers inflationary pressure away from the borrower. When variable or unsecured, it magnifies vulnerability. This is why outcomes diverge so sharply. Not because of effort alone, but because of positioning within the system. The architecture rewards understanding. It penalizes stagnation. This does not mean collapse is inevitable. Systems adapt. Rules evolve. But transitions are rarely smooth. History suggests monetary regimes change when confidence erodes through inflation, fragmentation, or geopolitical realignment. No system lasts forever. Each reflects the constraints and priorities of its era. The current one excels at scale and speed. It struggles with equity and resilience. For individuals, the challenge is not prediction, but alignment. Understanding the structure allows for informed decisions rather than inherited assumptions. The economy is not a mystery. It is a framework built by humans, governed by incentives, constrained by energy, trust, and belief. Those who recognize the rules early gain options. Those who rely on outdated maps feel lost. This is not a call to fear or certainty. It is an invitation to clarity. Because once the system is seen for what it is, it stops being intimidating. And understanding, in any era, remains the most valuable asset of all.